When money floods in, the price rockets. But when money floods out, there's no floor. There's no central bank stepping in to buy. There's no reserve currency status propping it up. Just a small market getting hit by big waves.
In 2011, silver went up 160% in less than a year. Gold went up 30%. Same economic crisis, same scared investors, same flight to safety. But silver moved 5 times harder, and then it collapsed twice as fast. If you've ever wondered why silver acts like gold's hyperactive younger brother, the answer isn't what most people think. It's not about industrial demand, it's not about manipulation, and it's definitely not about some secret cabal controlling prices from a basement in Zurich. It's about math. Specifically, the math of what happens when a small market gets punched by big money. Let me show you something. The entire global gold market is worth about $15 trillion. That includes every gold bar in every vault, every wedding ring, every central bank reserve, every coin tucked under someone's mattress in Mumbai. 15 trillion. The entire global silver market is worth about 1.4 trillion, 1/10 the size. Now here's where it gets interesting. When money flows into gold, it's like pouring a bucket of water into a swimming pool. The level rises, but gradually, there's a lot of space to absorb the flow. When that same bucket gets poured into silver, it's like dumping it into a bathtub. Same amount of water, much smaller container, much bigger splash. This is called low liquidity, and it's the single most important thing to understand about why silver moves the way it does. Let's put numbers on this. In 2020, during the pandemic, institutional investors poured roughly $40 billion into precious metals. A decent chunk went into silver, not even half, maybe $10 billion. $10 billion is a rounding error in the gold market. It's less than 1% of total value. But in silver, $10 billion is almost 1% of the entire global market. That's enough to move the needle hard. Silver jumped 47% that year. Gold went up 25%, not because silver became twice as valuable, not because the fundamentals changed twice as much, because the market is half the size and the same force hit it twice as hard. Now you might be thinking, okay, so silver is more volatile because it's smaller. That's just supply and demand, right? Right. But there's a twist. Silver isn't just smaller, it's also weirder. Gold is pretty simple. About 50% of gold demand comes from investment and central banks. People buy it to store value. The rest is jewelry and a tiny sliver of industrial use. Silver is split 3 ways, roughly 1/3 investment, 1/3 jewelry and silverware, and 1/3 industrial applications. Solar panels, electronics, medical devices, batteries, mirrors, water purification. Silver is the most conductive metal on Earth. It doesn't corrode easily, and it kills bacteria on contact. Which means silver has a split personality. Half the time, it acts like gold, a safe haven, a store of value, something people run to when the world feels unstable. The other half, it acts like copper, a factory input, something that moves with manufacturing output and technology demand. So, when the economy is booming, silver goes up because factories need it. When the economy is collapsing, silver goes up because investors want it. And when investors panic while factories are still running, silver goes parabolic. Here's the uncomfortable part. Because silver's market is so small, it doesn't take much to create a frenzy. In January 2021, a group on Reddit decided to try and squeeze the silver market. They called it a movement against big banks. The idea was simple: buy physical silver, drain the supply, force the price up. It didn't work. Not really. The price spiked for a few days, then settled back down. But here's what did happen. For about 72 hours, you couldn't find silver coins anywhere. Dealers sold out. Premiums on physical silver shot up 50%, even though the spot price barely moved. Why? Because the physical silver market, the actual coins and bars regular people can buy, is even smaller than the paper market. There's only about 2 billion ounces of silver in the form of investment-grade bullion in the entire world. 2 billion sounds like a lot, until you realize that's only about $50 billion worth. For context,
Apple has more than $50 billion in cash sitting in a bank account right now. One company could, in theory, buy the entire global investment silver bar on the planet and still have money left over for snacks. This is why silver bugs, the people who've been screaming about silver for decades, are both right and wrong. They're right that silver is undervalued relative to its industrial importance. They're right that the market is tiny and vulnerable to shocks. But they're wrong when they act like silver is about to go to $500 an ounce and stay there. Because the thing that makes silver jump fast is the same thing that makes it crash fast. Low liquidity cuts both ways. When money floods in, the price rockets. But when money floods out, there's no floor. There's no central bank stepping in to buy. There's no reserve currency status propping it up. Just a small market getting hit by big waves. Let's go back to 2011 for a second. Silver hit $49 an ounce in April. People were talking about $100 silver, $200 silver, the end of fiat currency. By September, it was back under $30. By 2015, it was $14. What happened? Nothing dramatic. The fear trade faded. Investors rotated out. Industrial demand stayed steady but didn't spike. And because the market was small, the exit was violent. Gold fell, too, during that period, but it fell 45%. Silver fell 70%. Same trend, different magnitude. This is the pattern, always has been. Silver amplifies whatever gold is doing, up or down. It's not a hedge, it's a leveraged bet on the same thesis. There's one more thing that makes silver extra volatile, and almost nobody talks about it. Silver gets mined as a byproduct. 70% of all silver comes out of the ground while companies are digging for something else: zinc, lead, copper, gold. Which means when those metals are profitable to mine, you get silver whether you want it or not. And when those metals crash, silver's supply doesn't drop as much as you'd expect because companies are still mining the primary metal. So, silver's supply is weirdly inelastic. It doesn't respond cleanly to price signals. That creates these strange situations where silver demand is surging, but supply barely tightens because it's tied to the economics of 5 other metals. It's like trying to control the temperature of your shower, but the knob is connected to your neighbor's dishwasher. So where does this leave us? If you're looking at silver as an investment, you need to be very honest with yourself about what you're actually buying. You're not buying stability, you're not buying a safe haven, you're buying volatility with a precious metal sticker on it. That's not a bad thing. Volatility creates opportunity, but it also creates risk. And the risk isn't just that silver might go down, it's that it might go down violently at the exact moment you need liquidity the most. Because here's the cruel irony. The times when silver spikes hardest are the times when everything else is also breaking. And the times when you'd want to sell silver to cover losses elsewhere are the times when nobody's buying. There's a reason gold is in central bank vaults and silver is in your uncle's garage. Gold is the serious one, the one that shows up on time, the one governments trust when the chips are down. Silver is the wild card, the one that shows up late, makes a scene, and leaves early. Both are real, both are valuable, but only one of them moves like the floor just dropped out. And that's not a bug, that's the whole point. Here's the question nobody wants to ask. If silver moves faster than gold, and you know it's going to be more volatile, why does it always surprise people when it crashes? Maybe because we want to believe that something small and scrappy will outrun the giant. Or maybe because in markets, the thing that feels like opportunity and the thing that feels like danger are usually the same thing wearing different masks. Silver doesn't jump faster than gold because it's better. It jumps faster because it's smaller. And smaller things break easier. This video is for educational purposes only and simplifies market mechanics. It is not financial advice. Market conditions, data, and regulations change over time. Always do your own research or consult a professional before making investment decisions.